Can we get cuts without going into a recession is the big question. Markets are in turmoil, everybody. We woke up Monday morning to a bloodbath in the global markets. The drama. Let's get you updated. If you don't know me, I'm Nikki Dunn. I'm the author of the book, Do This With Your Money. I'm a certified financial planner and a registered investment advisor, and I'm here to help you be smarter about investing and the markets and not making big mistakes with your money. So let's just start with what the markets are doing. The S&P 500 is a stock index we love to use to gauge what's going on with our U.S. market. We were down roughly 10% from the highs. Most of that sell-off happening in the past 3 trading sessions. Surprisingly, we are bouncing today, and we'll talk about, why that could be happening in a minute and how to think of it going forward. But essentially, the stock market gave us the correction we've all been wanting to see, at least the people that are, really doing wealth right. For those of us looking for a deal, those of us that have been kind of waiting on the sidelines with cash, this has been a time where we need to perk up our ears and pay attention to what's going on to potentially allocate capital to the markets. Then there was the NASDAQ, which was down roughly 15% near the lows. Keep in mind that this 200-day moving average, which is a pretty important marker that we look at in just technical analysis world, we did poke through that 200-day moving average. We hadn't tested the 200-day moving average. It looks like since 2023. We didn't even touch it in 2023, actually. So let me go back even further. The last time we've actually tagged it was back in March of 2023. So it's been quite a while. It's been over a year since we've actually tagged the 200-day moving average. So I personally, and I've talked about this in our wealth building community, I did a class recently on high risk markets, and I mentioned this exact fact weeks ago that we should probably expect that we might be tagging the 200-day moving average at some point, and we could be looking at a very high probability scenario based off everything that we were seeing that this could happen sooner rather than later. And then as you can see, the S&P 500 has not quite tagged the 200-day moving average yet. That's where we're at in terms of the severity of the corrections that we're seeing in the indices. Bitcoin is also down quite a bit as well, and saw a sell-off along with all the other risk assets. No surprise there. Even though this sounds scary, and even the fear and greed index is showing that we're in extreme fear, we are not even in a bear market. We're not close to a bear market yet. So bear market territory is seeing the stock market indices down 20% or more. We still have a ways to go before we're in any kind of bear market territory. Obviously, the NASDAQ will hit that number before the S&P 500 does because it's just more volatile. And with the headlines and with everything we're seeing, it just feels like the sentiment is just so bad right now. And that could very well be for many different reasons, but mainly it's because not only is the Fed looking to start cutting interest rates soon, but the economic data is starting to deteriorate and weaken. But before I get into that, it's important to note that the stock indices are still showing gains year to date. Now, this could change, of course, but that just goes to show you how high the indices did fly, that we have seen these pretty significant corrections in the past few weeks. However, the indices are still showing gains. This is where things really started to heat up. We got the unemployment data on Friday, the unemployment rate. And it basically ticked up to 4.3%. And we can see very clearly since March, we've been in this uptrend where unemployment has been rising, meaning more people don't have jobs. Now, the Federal Reserve has 2 jobs. They need to keep the labor market healthy and steady, and they also need to keep inflation tame. So they have been taming inflation with higher interest rates, but now the labor market is starting to be on shaky ground, and that can become problematic and lead us into a recession. And what's really spooking investors is that when the unemployment rate starts to rise, it usually keeps rising. It usually doesn't slow down. Now let's talk about this for a second. This top window is the unemployment rate, and then below that, these 2 windows are going to be jobless claims, which I'll talk about in a second. But the unemployment rate pre-pandemic was extraordinarily, historically low, around 3.5 to 3.6%. Now we are starting to really show a clear increase from those pre-pandemic levels. It's not essentially normalizing as much as it's actually just elevated and higher. So that is something that, is spooking the markets, and it's actually considering the market to price in interest rate cuts as soon as September, which I'm sure a lot of you that have been wanting to purchase real estate, you're probably excited about interest rate cuts. Now, the unemployment rate, it can be a noisy indicator at times. There's seasonality issues, response issues, who's responding to the survey, many things that can be kind of weird and noisy. However, it is the data we have, so we use it. But when I look at the initial claims for unemployment and the continuing claims, meaning people that are losing their jobs, going to the state and saying, hey, I'm unemployed, I need money every week, these numbers are kind of interesting. So when we look at initial claims, right now we're running around 250,000, we'll just round that up, of initial jobless claims. Pre-pandemic, we were anywhere from 210 to 248. So we're actually not too far off in terms of pre-pandemic levels with initial jobless claims. Continuing claims, pre-pandemic, we were around 1.5 million, up to 1.9 million, and we're running about the same. So it depended on the time of the year, but generally speaking, we were seeing very similar continuing claims numbers before the pandemic versus now. So when we look at the unemployment claims data, it's not really telling us a story of, oh my gosh, everything is falling apart in the labor market. I would say that right now, I'm very closely watching all of these data points. I'm watching the unemployment rate. I'm watching continuing claims. If continuing claims and initial jobless claims really start to ramp up and we see that trend similarly to the unemployment rate, of course, that's going to be saying to the markets, hey, things really are deteriorating and you should probably be very concerned about this. Then today, we got the United States ISM Services PMI, which this is going to tell us kind of the demand for services. This has been a little all over the place. We've had, some months that didn't look so great, followed by months that looked fine. This month for July's report, we ended up seeing okay ISM Services PMI report. So this is not necessarily flashing cause for concerns. When we look at the economy as a whole, people are either buying goods or they're buying services or they're buying both, right? So we like to keep an eye on that. And currently, we're starting to see goods start to come back, but consumers are still being very cautious with buying goods. But services seem to still be holding up pretty well. And a lot of that has to do with the strong demand coming out of the pandemic. Okay, so let's shift to putting this all together and going even deeper. We know that the stock market, measured by the S&P 500, is correcting. It's a healthy correction. We are getting close to tagging that 200-day moving average, which we haven't tagged in a very long time. We know that the unemployment rate is rising and that the market is spooked that we could be going into a recession if the labor market deteriorates further. Now, I did a class not long ago for the wealth building community members. It's in the community member classes course in their members area. And this is the class. It was called Portfolio Management Strategies in a High Risk Market. And my message in this class was essentially when the Fed starts to cut rates, typically the stock market is going to start to fall right before those cuts start to set in. So I warned the wealth building community members weeks ago that, hey, here's why this is a higher risk market today, higher valuation. We are likely going to see rate cuts. Typically, the stock market will sell off into those rate cuts, either before or into them. And so there were a lot of things that were getting us closer to the fact that, hey, we may see a correction. So I hope that my wealth building community members are, plenty prepared for this. By the way, in the wealth building community, the community member classes, these are classes that I've personally created as a financial advisor and taught to the members to help them manage their portfolios better, their, tax strategy, estate planning, mindset. So this is just a really great resource for anybody that's not in the community and you want to level up. this is the place to do it. Make sure to check that out. I'll put the link in the description below for anybody that wants to join the community and get 50% off their first month or quarter. The point is, the writing has been on the wall for those who were really paying attention and know how to dive into the data that a stock market correction was on its way. And there's plenty of other pieces of data besides the labor market kind of showing us this deterioration. For example, this is data from the New York Fed, and we can see credit cards, that's going to be the blue line. Credit card delinquencies, 90 days or more, that's pretty significant. These are up above pre-pandemic levels, and they're not quite to 2008 financial crisis levels, but they are increasing, and that is concerning. And so that's something that we're watching. As far as student loans, there was a program that came out that the administration passed, SAVE, and a lot of people were able to reduce their student loan payments based on this SAVE program. So that did save a lot of people. Auto loan delinquencies were starting to get pretty concerning, but it seems like that's kind of leveling out. Data shows that there's some weakening going on there and the consumer's having a bit more trouble. So that leads me to, well, what now? Where are we going from here? Well, if I had to guess by talking to my audience here, I would guess that half of you are probably pretty excited that interest rates are going to be going down, potentially, very likely. Whether you have variable interest rate debt, credit card debt, a HELOC, whether you're looking to purchase a home and you'd like to see affordability get a little better because interest rates are what's been crushing affordability for homes. And so there's that, part of the population. Then there's the other part of the population that maybe you don't care as much what happens because you've locked in your mortgage at 3%. You're not moving anytime soon. Maybe you have a little bit of savings. Maybe your debt isn't so high, doesn't bother you as much. So it's a bifurcation. That's the theme that I've been talking about a lot. Half of you probably are excited about rates coming down and it'll be a relief. And then the other half, maybe you don't care as much or it's not going to affect your life as much. I will say that this economic cycle has been anything but ordinary. From 2020 on, a lot of the things that we've seen have been pretty historic. Historic amount of stimulus that went into the system. Historic amount of people not getting out in the world and traveling. They were stuck in their homes. And what that has done for the flip side of that, people getting out of their homes and wanting to travel, wanting to go to restaurants, we saw inflation take its toll with people kind of getting back out there. We haven't really seen anything like that, at least in our lifetimes, which begs the question that's on my mind. Historically, yes, we have seen interest rate cuts lead to stock market sell-offs and recessions. Can we get cuts without going into a recession is the big question. And I am starting to lean towards I think it's possible. I actually tweeted about this. I tweeted about the seesaw effect that I'm seeing. One side may lift as the other side is heavier, helping things kind of balance out. So just a few things that I noted in this tweet. Industries like real estate, which have suffered, could end up getting a boost when interest rates get cut, right? And that could help offset the weakness that we are seeing now in other discretionary categories. We know that Starbucks didn't do too well, McDonald's didn't do too well. We know that Target and Walmart have had to cut prices because consumers are, reacting and pulling back. What I'm thinking is the other side of that is when rates do eventually cut, real estate agents will get a reprieve, mortgage lenders will get a reprieve. We might see some more refinancing come into the mix depending on how low rates go. That could help bring some discretionary income to certain households' pockets. So there could very well be a balancing act where one side helps balance the other side out that's falling. Have you ever heard the saying, real estate is the economy? It's because it really does drive a lot in the economy. Home goods sales, people going out buying furniture, going to Lowe's, going to Home Depot. They're probably not going to do that until rates start to drop. Now, in relation to stocks, it's been all about the Magnificent Seven. And the Magnificent Seven has become a very concentrated part of the S&P 500. However, we can't forget that there's a whole nother 493 stocks in the S&P 500. So what could end up happening is we could see a rotation out of the higher priced tech companies into the lower, 493 stocks that are showing more value, people may switch from growth to value going into some riskier economic environments. That's very possible that the balance between people leaving tech and going into value, that bottom 493 stocks that nobody wants to ever talk about, could help the S&P 500 stay afloat. Another thing is lower interest rates may give smaller companies a boost that could also help fight weakness in other areas. And then on top of it all, we can't leave each other without talking about the money market mutual fund assets. We've seen some pretty strong bounces in individual stocks and the indices today. Apple was up a ton, bouncing off of a major sell-off after Berkshire Hathaway sold a large percentage of their stake. Just check out this gnarly candle from today. Indices were up quite a bit. There has been buying demand today off of some pretty big sell-offs. And the money market mutual fund situation could also be another thing that keeps things afloat as well, for two reasons. One, just look at this. I mean, we've got over $6 trillion in money market mutual funds. That level has come down slightly as people probably were putting some money into bonds, putting some money into stocks, but we're still talking about a monster level of assets here. The second thing is when interest rates go down, that typically pushes people into risk assets like stocks. Right now, people are getting paid quite a bit of money to just sit in cash, sit pretty, and not take on risk. However, depending on what the Fed does with interest rates going forward, it's very possible that as rates fall, this money market mutual fund cash is going to be forced into assets, whether it's bonds, whether it's stocks, typically risk assets. So this is something that I'm going to be also watching closely, and another, notch on the belt of things that could keep us from going into a super deep recession, and B, a super deep bear market correction. That's a lot. I didn't even get to cover everything. There's so much more. There's the global markets, what's going on in Europe, what's going on in Japan. There are a lot of things that are affecting the sentiment out there right now. And then there's earnings, of course. How could I forget? Earnings expectations are pretty high still for the current year, 2024. So even though we've gotten some of a revision downwards in earnings expectations from 11.1% to 10.8%, the earnings growth for 2024 is still expected to be pretty robust, double-digit growth. So granted, this could continue to go down over the rest of the year, but so far, kind of so good. Earnings expectations are going to really need to crumble for us to expect super low levels in the S&P 500 or the NASDAQ. There's a lot that we're processing right now. Like I said, there's that balancing act that could be happening with the good and the bad, and the reactions from low interest rates, and what happens with the money market mutual fund cash, lots of cash on the sidelines. People really want to get into homes in a more affordable way. Maybe low rates will help do that and spur the economy. On the flip side, if the unemployment rate doesn't stop going up so fast, then we could end up in a bind. We could end up where the dominoes fall, because if people are unemployed, guess what? No one's buying anything. So there's a lot still to be seen, but I don't think that we have a reason to panic yet. I personally think that any deeper correction from here is going to be a buying opportunity going forward, especially with the earnings growth expectations. Doesn't seem like that's really budging a whole lot. So I think that earnings has shown us that things are okay. They're not great. Things are just okay. So are things going to be able to stay okay is the question. If you're not in the wealth building community, it's pretty dope. We have a lot of fun in there. We have built out these educational courses for you. There's courses for stock investing, fundamental stock investing taught by a hedge fund analyst. There's crypto investing and trading if you're interested in dabbling in that. There's wealth planning, which I do, yours truly. I help you with your wealth planning skill set. And obviously all the live classes that I've done. So definitely check out joining the community. The link is going to be in the description below. I'll put a promo code there so you can get 50% off your first quarter or month. And we packed a lot of value in this community so that you can become the best investor possible. I'll also throw a link to get my book if you haven't already gotten that. If you like this video, please hit the like button for me. I really appreciate your time and you being in this community. Until next time.